The following presentation was made possible by the Alltech Media Group, a Southern California multimedia company providing exponential branding and marketing services to all their clients. The Alltech Media Group understands the value of the 3W strategy, providing their clients proven, trackable results. Let us make it easy for you to grow your business. Visit alltechmedia.com.
Hello and welcome to EB5 Investment Reports Dialogue Series. Today we are joined by Michael Gibson, Managing Director of USadvisors.org, a source of information on the EB5 program. US Advisors is comprised of financial analysts, economists, accountants, and mathematicians that analyze all aspects of EB5 projects, from job creation methodology to exit strategies. Recently, US Advisors launched their latest platform, EB5M.com, providing research and due diligence for foreign investors on projects in the U.S. Today, in part one of Michael's interview, we discuss the importance of due diligence, how it relates to the lawsuits that have recently made headlines, and what investors can do to ensure their project is on the right track. In part two, we will be talking about the hottest topics today in EB5, transparency and immigration broker fees. Welcome to the show, Michael.
Thank you, Amy. Thank you for inviting me.
Can you tell us a little bit about your background and about your website and your new website that you just recently launched?
Sure. So US Advisors really stems from my experience working with Citicorp. I was with Citicorp Capital Markets for a number of years, primarily working emerging markets. So what I was doing there was mostly fixed income and some derivatives, hedging, trading. We were managing the risk for the bank, managing the risk for our clients. We did a lot of funding, large project funding for some very large sovereign states. So I was in the Middle East, I was in Latin America and Africa. And I learned a lot about managing our risk for the bank as well as for our clients' risk. And when I left Citibank, I was looking for something to do. And I happened to meet an immigration attorney, oddly enough, during a Christmas vacation. And she explained about this program, and she asked, with my background, would I be able to look at some of the projects. This was in 2006. At the time, there were only 13 regional centers, and I believe there were 4 or 5 different projects in the market. So I had a look at these projects, and I saw some issues, some concerns that I had with, again, using my background at the bank. And I explained those to her, and she said, would you mind giving us some more insight? And I said, well, really probably the only way I can actually do this is to go on site, to do a site visit, meet with the developers, because at that time there was not a lot of information. There was not the investment report, there were no trade associations, there were no EB5 conferences. At that time, there was really very little information in the market as to who the developers were and what they were doing. And the offering documents were horrible. The business plans, they were a nightmare. Some of them didn't even have business plans. So I felt the only way that we could actually do a proper risk assessment was to go do a site visit, meet with the developers, meet with the control persons, and see what it is they were actually proposing to do with the capital that they were going to raise, both EB5 and more traditional sources of financing, such as a bank loan. And so I went around the United States. This was in 2007, and I visited all of the regional centers at that time. And I think by the time I finished the trip took about 3 months' time in total, going from east to west and across the country. And I filmed all of those projects. I think that experience, at the time I finished over 18 regional centers, the experience showed me that the EB5 program is a fantastic program for developers raising capital, for the investors who are going to get their green card. But at the same time, I saw that there was a huge amount of lack of information on what the projects were trying to accomplish, their goals, and certainly information that was not getting to the investors. So I decided at that point to form US Advisors as a way to facilitate the flow of information, the risk analysis, the due diligence, not only for the investors, but for the attorneys who were seeking guidance on which projects were out there and how safe the projects were to accomplish their goals.
Can you tell us about EB5M that you just launched?
So, long story short, fast forward, this is since 2007, now we're in 2013. The industry has matured tremendously. So we are now approaching close to 300 regional centers. At any point in time in the market, there's probably between 30 to 50 projects being offered, all different sizes, shapes, different asset classes, different industry groups. And the problem is, for anybody in the industry, there's just simply no one source for information. So what we have done, we have approached several regional centers, broker-dealers, FINRA-registered broker-dealers, and others in the industry to say, would you mind sharing information with us on what your projects are, and would you mind allowing people to access that information? So we have put together this platform, which essentially, the way I describe it, the analogy I use is similar to one that we had in fixed income. When I first started with Citicorp in the 1980s, we didn't have a fixed income trading system. We used Reuters and Telerate terminals to get pricing information, but there was no way to analyze all of the different CUSIPs and the fixed income issues. So Bloomberg finally came out with his machine, and he licensed the technology to Citibank. So we were able to use that to do our pricing and risk analysis. And I'm using that same analogy. So our EB5M.com platform is similar to the Bloomberg in that it will allow for everybody in the industry, whether they're issuers, they're attorneys, they're investors, they're agents, to log onto the system, see what all of the different projects are in the market, and as well there'll be some information, there'll be some general information about the projects, and depending on the issuer, they can upload more or less according to how comfortable they feel releasing information to the industry. The point is, it's a central processing place so that people can not only find out information about the different projects, but they can also act on that. So they can actually subscribe. Since this is going through a registered broker-dealer, what all of the people who access that information will have to be vetted. So they will be, there are three things that we will do. The know your client, so we know if they're who they are and some background information. We can determine that that person is actually the person who's accessing the information. We're going to do the accreditation test, so we'll know if they're accredited or non-accredited, and we'll do the suitability to ensure that they are aware that these are liquid instruments and that they're suitable for investing in these instruments.
Michael, due diligence is a word that comes up often. It sounds like your website is helping those involved in the industry do their due diligence. For our viewers, can you explain what due diligence is and why it's so important?
Right. Essentially what we try to do, when somebody sees the offering package, it's quite comprehensive. If we had one on the table, it would be several inches high and weigh several pounds, maybe 10 or 20 pounds. Because in there you're going to have typically in an offering package you have a limited partnership agreement, you have a private placement memorandum, you have a business plan which may be detailed, and you're going to have also the economic impact analysis. And there may be additional information on top of that. So what we try to do is go through all of these offering documents and provide the investors with the material information that they would need to make an investment decision. Due diligence, the way we look at it, is uncovering not only the information which is in the offering documents, but also looking at the market. So all of these projects are building or doing something with the capital. And typically we see about 70 or 80% are building some sort of commercial real estate property. So what we will want to determine is in that market that they're building the asset for, whether it's a hotel, a casino, a shopping center, or a redevelopment of any of these, an office building, we want to see what is the appetite in that market for this asset. What are the vacancy rates? What is the absorption rates? What is the demand in that? So if they build it, it's not like the movie where if you build it, they will come. in many cases, we're seeing projects which are being developed for which we do not see a market need. And another concern is that when we see the projected pro formas, the cash flows and the revenue projections, what we're seeing is a mismatch between what they're projected and what the market is actually showing to pay for these, for whatever the asset is. So I think from our standpoint, we look at due diligence as all the information that you would need to make a decision on whether that's a suitable investment for EB5 purposes, and that includes analyzing what the business plan says. And we have additional constraints because all of these materials have to be compliant with USCIS requirements. So in addition to being a good investment, we need to make sure, are they matter of HO compliant? Do they follow with all of the new and old USCIS guidelines regarding the job creation? And the artificial constraints imposed on the job creation timeline. So what we need to see is, will the asset be performing, will it stabilize, and will it do it in sufficient time to give the investors everything that they need so that they can file to remove the conditions at the I-829 stage.
How important is it for regional centers and developers who receive EB5 financing to be truthful and provide accurate information about their proposed projects? And what happens to regional centers and their developers who fraudulently make material misrepresentations about their projects?
I think it's a great question. Again, we're not a law firm, so we can't give legal advice. But what we would say from the investment standpoint is that as long as you're truthful and honest with your investors, and that includes the marketing agents, and I think this is the disconnect in our industry. I think by and large the developers are quite open about their projects and the risks that are entailed. And in fact, in the PPMs, you will see a risk disclosure section, which is usually fairly comprehensive. I think the problem in our industry is that it is handed off to a third party, a marketing agent, who may not have, say, the same constraints. And they feel, well, not only do they feel, they're being compensated to sell products. And so my sense is that these marketing agents, whether they're here in the United States or offshore, they have an incentive to not disclose the risk. Because if I tell you I want to sell you a car and I tell you the wheels may not work all that well, the trunk may not work, the engine doesn't start all the time when it's cold. If I tell you these things, you won't buy the car. Unfortunately, I think this lack of material disclosure to the investors about the risks involved in the investment, and we have to remember that in the world of private placement or private equity, these are among the most illiquid investments that you can make. So where you have publicly traded instruments like the stock exchange or commodities and futures, you can get in and out of those markets multiple times in a minute. If you buy a house, you can turn around and sell that right away. You may not get what you paid for, but it's a very liquid market. Same with almost any other asset. These private placement offerings, once you're usually in for a period of time, maybe 6 years to 8 or even longer. There's some investors who are 10 years in these instruments and they can't get out. So I think the problem is that when the agents do not fully disclose the risk to the investors, and the investors invest thinking there isn't going to be a problem. In fact, I've heard overseas where there's discussion of guarantees and other things. When something goes wrong in the investment, I think at that point you're going to find that the investor is going to look not to the marketing agent for relief, but they're going to come back to the developer or the issuer and say, we were told this, this, and that, and this was our understanding. And the developer may then have some issues to deal with, some legal issues to deal with if they're to either make that investor whole or to come up with other sources of capital if there is something like rescission where they may have to return the capital invested to these limited partners. And so I think it brings up a whole host of issues for the developer if they're not keeping a close eye on what the marketing agent is saying.
Michael, going along those lines, our research shows that as early as November 2011, you started reporting on this huge Chicago EB5 multi-hotel project that was reported under scrutiny by investors. Can you tell us why that showed up on your radar?
It was brought to our attention by some investors who were looking to invest in the project. It was, at that time, it was probably the most heavily marketed project in China. So it was on our radar screens. People in China were saying to us, what do you think about this? This is not only the largest project being marketed at the time, but it was also the one paying the highest commissions. So there were, I think, at least 24 or more migration agents in China promoting this project. And we were sent the offering documents. It didn't take us very long. It took us a few hours to realize that this was all nonsense. There was no substance to anything that they were claiming or promoting in the marketing material. And it was more disturbing because it wasn't just the marketing material from the centers, from the regional center, that was of concern. That was very troubling when you looked at it. But then when you looked at what all the agents were saying on top of that, the additional guarantees and claims and things that were simply not true. So we went through all of the claims that were being asserted, and we found that typically you're going to find problems with one or two, maybe a couple of areas where there could be some doubt as to what might be accurate or not. But we found in this case nothing that he said was factual. So we reported on that, and we thought that would be the end of it. Well, not that everybody in China reads our blog, but we thought certainly anybody who spent a few hours doing some level of due diligence would find out that none of the things that they were claiming were true. And yet 2 years later, we found that the project was still being marketed, and we were actually in the process of writing a follow-up just as the time of the SEC action happened. And while that took the industry by surprise, I don't think anybody who spent just even a few hours looking at the documents would have been surprised.
Now, where did the investors fail on that? Not doing their due diligence? How did this happen?
Yeah, this was easy. There was no due diligence done by anybody. I don't think the state of Illinois, who they had the governor on stage presenting with the developer, they certainly had no idea. I mean, you don't even need to do a site visit. As I say, in most cases, we do site visits. I think, but anybody who had done a site visit or even a Google search would have seen there is no possible way that they can make a convention center that is not only not anywhere near downtown, but not even near the airport. It's in the middle of nowhere, out by O'Hare in a small, I think it's a 3.1 acre parcel, and they were going to put 5 hotels there. I mean, the whole thing was fantasy. So I don't know anybody involved in that chain, whether they were the attorneys or the agents or the service providers. I don't think anybody did any level of due diligence whatsoever.
It turns out that your concerns were right about the Intercontinental Trust of Chicago. And in February 2013, the SEC filed a civil complaint against that regional center and its founder for securities fraud. So why does the SEC often refer to Sethi, the founder of this project, as the 14-year-old developer?
Well, one of the claims that he made, which was outstanding, and again, this is where I blame the U.S. service providers, because I can see how the Chinese investors, they don't know. They don't know where Chicago is, much less this small acre parcel outside of O'Hare. I understand how the Chinese investors do not understand that you cannot fit 5 hotels onto a small block, and that there isn't a $300 million sovereign commitment from a foreign entity, or any of the other claims that they were being made. But the U.S. service providers, and there were at least, I'm going to say probably a dozen people on the U.S. side, attorneys, and other economists and other service providers who touched this deal, who were involved in this, and to some extent supported the deal, at least, if not by going to China and making public support statements. They supported it by doing some service for this offering, and then putting that, the developer would then use that, their logos or their experience in their firm, to show the investors that don't believe what we're saying, look at what these firms are saying. they trust what we're saying, and they've done the work. So on the U.S. side, I think there is a problem in that there is a lack of due diligence on the client engagement. So you have attorneys and economists and others who will simply engage with almost any client regardless of the claim. So one of the claim that the SEC was referring to was where SETI had claimed that he, I think, had 15 years of commercial construction development experience, and he was only 29. So if you do the math, it would have been 14 when he started, which again, it just, some of the, I mean, when we review offering documents, we oftentimes find discrepancies between what the developer may be claiming and what the market may be supporting. As Ronald Reagan would say, the trust but verify. It's not that we don't trust what the developer is saying, but when we verify the facts, some things don't add up. And in this case, on the U.S. side, the people who provided service to SETI and the others in his group, I think they may have been misled, but at the same time, I think it's their own proper responsibility, not only for their firms, but then down the road for the investors who may have, in this case, they didn't lose that much money, but for those who do, they may come looking for relief to them because they supported that engagement. And I think if you look at some of these statements, you would just, at the inception say there's no possible way.
Now, there was another project company that I read about in one of your newsletters. It was the Neogenics oncology. Can you explain that, and can you tell us what lesson can be learned when raising capital and dealing with finder's fees regarding this?
Yeah, and this is an issue, I think, in our industry that is going to be probably more problematic as we go forward. And I think the case of Neogenics is a good warning sign for people who are raising capital and doing that by paying third parties who may not be registered. And the issue with Neogenics was that they used a US-based finder to raise a significant amount of capital. What happened then was the CPA firm who was doing the audits of their financial records would not sign off because they were concerned that the payments of fees to non-registered persons could invoke something called rescission, meaning that the Neogenics might have to return the capital back to the investors by paying a third party. It was pretty clear that the third party was a broker in that transaction. Whether he had to be registered or not could be a matter of some debate, but I think the SEC's view is that anybody paid a commission in the sale of a security should be registered. Mm-hmm. So in this case, what happened was the CPA firm would not sign off on the financials if they did not include a note in there saying that there is a possibility of rescission, all of the capital may have to be returned. This caused a delay in the filing of their quarterly statement, and this delay in the filing, this was a fairly illiquid company. I mean, they relied on the pink sheets, which is an over-the-counter trading system. So when this came out, the delay in the filing, and the reason why the filing was delayed, it actually put the company into bankruptcy. I think the lesson that we can learn here is that as the SEC becomes more involved, and it's not just the federal government, but the state governments. We're here in California. The state of California has a very active Securities Enforcement Division. Where our office is based in Florida, we have equally a strong enforcement. New York, Texas. Some of these states' securities regulators are looking into this payment activity finder. In Florida, we have a lot of problems because these finders are raising capital and they're putting them into things like Ponzi schemes. So what we're seeing is more concern from the regulatory standpoint that these finders may be doing things which are not legal. And I think in the case where the investors then find faults for whatever reason in either the investment, they're not happy with what happened. For instance, in the EB5, perhaps they didn't get their green card, the conditions removed at 829, and they find out that a third party, non-registered person was compensated, was paid finder's fees, in the raise, they could then, theoretically, hire an attorney and ask the principals to return their capital, because the exemption, the Reg D or the Reg S exemption, was violated. So violating the exemption provisions, which may include not paying third parties who are not registered, could be a problem for people raising capital in the EB5 space.
Now, how can investors protect themselves from being caught up in lawsuits and bad projects, and like we discussed, and how important is it for the investors to have an exit strategy?
Well, and this is really, I'm going to take a step back, because okay. I don't know that we can rely on these investors to do a whole lot. By and large, these people, while they're very intelligent and they have been very successful, they are not sophisticated investment analysts or experts. So I have the expectation that investors really don't know what it is that they're doing. And in our industry, I really find I take a bit of an issue with especially the immigration attorneys who are not recognizing this. I think they're assuming that their clients are sophisticated. They may be technically, by the securities definition, they may be accredited and they may have signed off that they're sophisticated, but by and large the investors are not. They do not understand the illiquidity and the risk involved in commercial real estate development or any number of other asset classes, commodity extraction, manufacturing. So our viewpoint is our clients are not sophisticated. So it's our job to explain to them in as much detail as we can what all the risks are involved in these investments so they can make a better informed decision. But I think that step is skipped in most cases, and I think the fault I would place firmly at the foot of the immigration attorneys, who may not be giving their clients sufficient guidance. Now, they may say we won't give them investment guidance, but then they should find somebody who can give them, whether they're another investment advisory firm or a CPA or somebody who's an expert in that industry, to guide them, because unfortunately, I think what's going to happen is these clients, if they do make an investment and it turns out to be a poor choice, they're going to look to the immigration attorney for relief. So for the immigration attorneys who may be watching this, I would guide them to get as much second, third-party opinion on these investments, because the investor, if they lose their money or they lose the petition for residency, are going to be very upset, and I think they're going to look to them for relief.
After this short break, we will be back with Michael to discuss the latest hot topics in the EB5 industry: transparency and immigration broker fees.
The following presentation was made possible by the Alltech Media Group, a Southern California multimedia company providing exponential branding and marketing services to all their clients. The Alltech Media Group understands the value of the 3W strategy, providing their clients proven, trackable results. Let us make it easy for you to grow your business. Visit alltechmedia.com.